If you're thinking about incorporating a self-directed IRA or self-directed solo 401k into your retirement strategy, you might be curious about which option is a better fit for you. Now, in today's video, we're going to deep dive into everything you need to know about investing with a self-directed IRA versus a self-directed solo 401k. So stay tuned to the end where I'm going to reveal a special update that you're not going to want to miss. So let's go ahead and dive on in. Now, what exactly are self-directed IRAs and solo 401ks? Before we examine the pros and cons of each investment vehicle, let's briefly discuss their definitions. Now, self-directed IRAs, also known as SDIRAs, are a type of individual retirement account similar to a standard individual retirement account or IRA. However, there is a significant difference. Now, a self-directed IRA allows you to incorporate specific alternative investments that aren't available in a regular IRA. So while regular IRAs permit stocks, bonds, mutual funds, and a few other common investments, self-directed IRAs enable the inclusion of alternative investments like real estate, privately held companies, metals, and a bunch more. But do you still need a trustee or custodian to hold your assets? Let's find out. Self-directed IRAs are dubbed self-directed because although a trustee or a custodian administers the account, it's managed by the account holder, and that's you. So these IRAs are available as either traditional or Roth IRAs. So with a traditional self-directed IRA, you make tax-deductible contributions, while with a Roth self-directed IRA, you make tax-free distributions when cashing out during retirement. So essentially, self-directed IRAs are very similar to standard IRAs, but with the added benefit of a wider range of assets, giving you more control over your money, okay? Now, let's discuss the self-directed solo 401ks. These are an alternative to regular 401ks, and like self-directed IRAs, allow you to invest in various assets. For example, self-directed 401ks enable you to invest in stocks, bonds, mutual funds, real estate, tax liens, private placement deals, precious metals, energy investments, even alternative currencies like crypto. However, there are still certain assets you can't invest in with self-directed 401ks, such as collectibles like artwork, baseball cards, or antiques, and insurance, unfortunately. Self-directed 401ks come in both traditional and Roth options, similar to self-directed IRAs. You are responsible for managing the investments, though another party will hold the assets on your behalf until you cash them out. So that's pretty sweet. Now, a frequently asked question is who can open a self-directed IRA or 401k? Almost anyone with earned income, a government-issued ID, and a debit or credit card to pay for the account establishment fees can open a self-directed IRA. The rules for self-directed 401ks are different as only business owners without employees can use them, okay? However, those with self-directed 401ks can include their spouses in the retirement plan, which creates a larger tax deduction and actually enhances the retirement planning. But what are the advantages and disadvantages of using self-directed IRAs and 401ks? So what are the pros and cons? Okay, one of the main pros is the freedom and control you get from self-directing your funds. So this is perfect for those who prefer investing in alternative assets or simply just enjoy having more control over their investments. Additionally, self-directed IRAs and 401ks offer many of the same tax benefits as their regular counterparts, so you won't miss out on any tax perks of the traditional 401ks and IRAs. However, there are a few cons to consider. Now, some people view self-directed IRAs and 401ks as higher risk due to their self-managed nature. In other words, unless you're an expert investor, selecting the assets for your 401k or IRA can be a risky endeavor. On the other hand, if you know what you're doing, there is a potential for higher returns. Another possible drawback of self-directed IRAs and 401ks is the slightly higher fees. Now, this is because those who have self-directed IRAs and solo 401ks often make many trades and frequently add or remove assets from your accounts. So over time, the fees associated with these transactions can accumulate. So what sets apart self-directed IRAs and self-directed 401ks when it comes to taxes? Okay, now this is the fun part, and it took me a little while to really wrap my head around this, so bear with me. So there are specific taxes to keep in mind. The unrelated business income tax, or UBIT, and the unrelated debt finance income tax, or UDFI. If you're not familiar with these, listen up, because in the next few minutes, you're going to know more than most people. First, let's discuss UBIT. This tax is applied to unrelated business income earned by tax-exempt entities. Say that 5 times fast. Such as IRAs, other tax advantage accounts. In simpler terms, certain investment activities within your IRA can trigger taxes despite its tax advantage status. Now, the IRS doesn't apply UBIT to passive income like rental property income, interest, dividends, or royalties, but it does apply to active income investments like debt finance income, unrelated business income generated from unincorporated active businesses. So, if your IRA invests in private active businesses, expect to pay UBIT. Now, you may wonder if UBIT affects both self-directed IRAs and 401ks. The answer is yes, but it only applies to investments in private active businesses that aren't C corporations. For example, if your solo 401k, which is another term for a self-directed 401k, invests in a local restaurant and receives distributions, UBIT would apply. UBIT tax rates range between 0 and 37% depending on your unrelated business income. Now, let's look at UDFI, which is slightly different. UDFI is a tax applied to income generated within an IRA using debt to finance the purchase of income-producing assets like real estate. So, for example, if you use debt to buy real estate inside your self-directed IRA, the debt finance income would be subject to UDFI taxes. Self-directed IRAs are subject to UDFI taxes, but self-directed 401ks are not. So, if you plan to use debt to finance income-producing assets within your retirement account, use a self-directed solo 401k because that might be a better option to avoid that UDFI tax. UDFI tax rates range between 10 and 37% depending on income. Now, to avoid UBIT and UDFI taxes, consider a self-directed solo 401k over a self-directed IRA to bypass UDFI taxes altogether. In general, the best way to avoid both taxes is to invest only in passive income assets and steer clear of those active income investments. Now, whether you have a solo 401k or a self-directed IRA, avoid UBIT and UDFI taxes by investing in assets like stocks, mutual funds, precious metals, and foreign currency. If you prefer active business investments, consult a tax professional to minimize that UBIT and UDFI taxes. Now, when it comes to tax forms, the entity managing your self-directed IRA or solo 401k should file IRS Form 990T on your behalf to report any unrelated business income. They are also responsible for paying any UBIT or UDFI taxes directly from your retirement account, which may be viewed as either good or bad, depending on your individual perspective. Now, regardless of personal opinions, these are just the rules, and we all need to work with or really leverage them accordingly. Now, you may be wondering how UBIT and UDFI taxes impact the tax forms and filing process for your self-directed IRA or solo 401k. The entity responsible for administering your self-directed IRA or solo 401k must file IRS Form 990T on your behalf to report any unrelated business income you have. Additionally, this entity is required to pay the taxes from your self-directed IRA or solo 401k on your behalf, meaning you won't have to pay UBIT or UDFI taxes from your personal funds. Now, you might be asking, Mark, how does that actually work? Since your retirement account is the one purchasing the assets, it's also the one responsible for paying the taxes, so not you personally. Some people see this as a positive, as it doesn't affect their bank accounts, while others view this negatively as it essentially removes capital from their self-directed IRA or solo 401k. But regardless of anyone's stance on the matter, these are the rules and we need to navigate or leverage them as best as we can. So let's dive into opening a self-directed IRA. Now that you understand the tax implications for self-directed IRAs and 401ks, you can make an informed decision on whether this is the right choice for you. If you're ready to take control of your retirement planning, let's discuss the steps involved in opening a self-directed IRA. Now, number one, first and foremost, you'll need to find a custodian or trustee to manage your account. So to open a self-directed IRA, you must go through an authorized custodian or trustee. This entity will help handle your funds and pay relevant UBIT taxes using IRS Form 990T on your behalf. Not all major brokers or financial institutions offer self-directed IRAs, so do your research and shop around before year end if you want a tax deduction. If you're looking for some recommendations, there are actually a couple really good ones that are out there that I can actually recommend. Drop me a note in the comments below and I can hook you up. The second step is choosing the investments to include in your self-directed IRA. Now, this is the fun part. Keep in mind that the investments you select will influence whether you pay those UDFI taxes. However, consider that higher quality investments can lead to greater returns in retirement, so paying UBIT or UDFI taxes shouldn't deter you from pursuing potentially lucrative investments. Thirdly, conduct due diligence for your chosen investments. As a self-directed IRA holder, you have the responsibility to ensure your investments are sound. So be sure to complete all necessary due diligence before adding funds or making investments in your account. Finally, request that your trustee or custodian execute the desired transaction. After completing the previous steps, you can begin adding assets to your IRA and saving for retirement in a tax-advantaged manner. Now, with luck and smart investments, your IRA will grow over time, and when you retire, you'll have the funds you'll need to live a very comfortable life. Now, let's talk about opening a self-directed 401k, which is a slightly different process than opening an IRA. So to open a solo 401k, you'll need an employer identification number or EIN, a plan adoption agreement, and an application. So provide this information to your custodian or trustee who will guide you through the process. And if approved, you can start adding assets to your solo 401k right away. As for contribution limits, self-directed IRAs have the same limits as regular IRAs. So in 2023, this means $6,500 for individuals under 50 and $7,500 for those over 50. For solo 401ks, the limits are $66,000 for those under 50 and $73,500 for those over 50. While not everyone can max out these contributions, making consistent contributions each year can lead to substantial growth by the time you retire. Now, remember in the beginning I told you I had a special update for you. My crypto friends are going to love this one. So for those interested in cryptocurrency, here's an exciting piece of news. You can add cryptocurrency to your self-directed IRA or solo 401k. Yeah, this is pretty exciting. So the government permits adding cryptocurrencies like Bitcoin, Ethereum, there's tons of others, to these accounts as alternative investments. However, this doesn't mean you should invest only in cryptocurrencies or allocate a significant portion of your account to them given their volatility. Adding some crypto to your self-directed IRA or solo 401k can diversify your account, but make sure to conduct due diligence before making any crypto investments. If you need assistance in organizing your self-directed IRA or solo 401k contributions, along with other strategies like the Augusta loophole, home office deductions, vehicle write-offs, definitely reach out to a tax professional, and I'd be more than happy to be that tax professional for you. Definitely hit me up. If you're interested in working with me and my team, or you just need some recommendations on the best self-directed IRA and solo 401k service providers, just drop me a note in the comments below and I'll be sure to get in touch. Thank you so much for watching this video and being a dedicated follower of my channel. If you can do me a favor, please hit that like button and subscribe if you haven't already. All right, I'll see you all in the next video.